Hello and welcome. Today we will look at the several day trading strategies for the beginners. We will cover the main rules, and we will also see how to find high probability signals using the open price of the day. So if you could like, subscribe to the channel and stick around for the full video. The basics of every successful day trading strategy is good knowledge of the day price actions. The basics info on the daily price actions is the daily open high and the low daily opens, the prices at which markets opens the high in the highest point that price reached during the day, and the low is the lowest point that price reached during the day. Although their three levels are important for the current day, I am mainly interested in the daily open price. According to the daily open price, you can forecast the trend directions for the rest of the day, the downtrends, uptrends, or the sideways price actions in the other. To make it easy as possible, I found this daily open indicator to have you easily read and analyze the price. You can find this daily open price on Tradingview. Now you have visual representations of the open price. If you look at the chart, you will notice how price never remains still around the daily open levels, unless it's a sideways trend, that because the opening price is one of the most important price levels for the day. Essentially, it represents the balance between the bullish and the bearish forces. That's why when the prices are above the opening prices, the market is considering bullish. If the price fell below the opening price, the market is considered bearish. The opening price provides the standard support and resistance functions on the price charts. When price actions reach the opening price, it could act as a support or resistance, or it could break the level and continue on the intraday trend. Notice how price reach the daily open price. When the market is active, price simply doesn't stay around the level of the daily opening price, but forms down or uptrends above or under the line instead. So this is the first things you need to remember. The daily open line will become strong support and resistance during the trading day. This is very important, and you should always check the level regardless of which strategy you use. Support and resistance levels based on the daily open price levels can be used just like traditional support and resistance level. The key is to watch price actions when these levels came into play. Should price decline to support and then hold, you can look for the successful test and bounce of the support. It often helps to look for the bullish chart pattern or the candlesticks formations, or for indicators signals to confirm upturn from the support military. Should price advantage to the resistance and stay, you can look for the failure at the resistance and decline. Again, you should look for the bearish confirmations or an indicator signals to confirm a downtrend from the resistance. All things considering, if you see price actions approaching the opening price levels on the chart, you should there the situations as a normal traditional level. Nevertheless, if the price starts staying when they're reaching this level and suddenly bounced in the opposite direction, so you might then trade in the directions of the bounce, but the price actions breaks through the opening price level, when you could expect the actions to continue in the directions of the breakout. What you need to know is that one open price assessed the general tone of the price actions. Move above the line is possible and shows a trend, while the move below the line shows the weakness. So How to trade using to the opening price. The locations of the opening price line on the chart represents important information to the aware of because there is the high probability that it will be reached at the beginning of the day. I like to compare the value of the opening price with the value of the previous day. If the current opening price line is higher than the previous one, I only consider taking long entries during the day. If the current opening price line is lower than the previous one, I consider taking only short entries. Basically, I want to find the returns to the day trade, the continuations in the directions of the short-term trend. I will sometimes miss huge moves in the opposite directions, but this filter will also save you money losing trade. I will also take into account the distance between the open price lines, meaning the range opening price lines located in the short distance one from another indicates the possible range. I avoid trading on the markets where the most recent opening lines are close, as the price will most likely to stay flat and often low probability entries. Just look at this example. The opening price is almost the same. Yes, we have some bonuses, but we also have the many false signals if you trade when the distance between the lines in the narrow channel change from the day trading perspective to the scalping one, and try to get to some points and get out quickly. Opening prices lines drawn at the largest distance between them indicates the trend market. This is what I like to see with the separation between the lines, which means we have a short-term trend at least. And I don't like to the line to be touched often. I don't want to see price moving above and below the line, crossing the line often. I want to open in line to be an obvious zone of support or resistance. When price reach to the area, I like to see a rejection or a momentum breakout. Also, when the distance between the opening price lines is too wide, you could also have the consolidation today. This means that we have the aggressive move the day before high average to range, so the market may pause to the next day, while you can perfectly trade with this setup alone. If you are good at reading prices actions, it's better to combine it with other trading tools. So let me show you several strategies involving opening prices line. First one is to the pinned bar rejection strategy. Trading with the trend is the best way to trade any market, and pin bar entry signals rejecting the opening price line in the trendy market can offer a high probability entry and good risk to reward scenario. In this example, we can see the bullish beer bar that formed in the context of the uptrend market right at the opening prices lines. This type of beam bar shows rejections of the lower prices with the long lower tail, so it's called the bullish pin bar since the implications of the rejections reflected in the pin bar is that the bull will resume the pull, pushing the price higher when the trading a pin bar counter to the against the domination trends. You should do so from a key chart level of support or resistance, and again this is where the opening price is important. This key level, the opening price, adds extra weight to the pin bar formations. Have a look at this chart. We have a double pin bar setups against the trend, right? At the opening price lines, it's not uncommon to see back or double pin bar patterns to form at key levels in the market. These patterns are trades just like the normal pin bars, except they provide a little more confirmation system. They reflected not one but two conventional rejections of the level. The second system is the exponential moving average high-low channels strategy. Price actions naturally swings up and down over the course of the day, but this swings tends to stay within the certain range, and those create a general upwards or downwards trend. A moving average channel allows you to observe when the price is moving and time trades around the opening price lines to find additional stopper resistance again to the channel. I've talked about the moving average high-low chances in this video, so make sure you watch it after this one. Basically, instead of the plotting one moving average based on the closing price, I started using the moving average channel. You will have two moving average forming channels which are applied to the bar's height and the lowest prices instead of the bar's close price. This moving average channel will filter a lot of the old signals. You know them all when the price goes above or below the moving average. You invitate positions and then immediately take the price close on the opposite sides of the average. With the channel you will have an area, a safety net, and you reduce some of the market noise using the moving average channel. You remove short-term fluctuations around the line, and at the same time knowing the overall directions at the trends of the market. When the price experiences with a strong move, the price will have to trend away to track back to the moving average channel, then continue the original directions it was moving when the channel and the opening prices lines come together around the same price level. Level you get an area of the value from the which you can take your trades. The trading signals can be triggered when the prices retreats to the moving average channel. In this case, 200 exponential moving average high-low area around the opening price lines are reached with the bonus. If you watch the price actions in real time, you will often see that your price slightly touches the moving average channels, and in some cases the touch will also include the opening price lines only to get forcefully rejected back. In the opposite directions, when the moving average channels is trending upwards, you should consider buying when the price bonus of the channel and the opening price the reverse splice when the channel is trending downwards, in which case you should be seeing when the price releases towards to the channel and gets rejected there. If you find a pin bar, that's even better signals. Remember to the previous strategy. If you have previous market lines around the area offering another layer of the confluence against the better. The third setup is the Heikin Ashi strategy. When you are trading or the scalping, candlestick charts may flip-flop considerably from the green bar to the red bar, but Heikin Ashi charts tend to have the longer range of the bars. This provides the clear highlights and the confirmations of the current trends when the Heikin as you won't show the exact price all the time. There are some benefits to using the charts. The main advantage is that they look much smoother, which helps you to identify the trends directions more easily. Heikin Ashi charts are also color coded as long as the price is rising. When the bars will show up green as long as the price is value. When the bars will show up as red, the price is above the opening price lines. With the Heikin Ashi candles turning to the green from the red, it indicates you that the price is about to turn higher. So you want to trade the green Heikin Ashi bars above the opening price lines. If the price below the line and the high Canadian candle turns red, indicates that the price is about to go down again to the trade red bars below the line. Remember that the green candle sticks with the no longer shattered or the weak indicates to the strong uptrends. So if you enter to the long trade or example, you can remain to the trade until the cover of the Heikin Ashi candlesticks change from the green to red. This allows your profits to run while they're riding to the short-term uptrend. By the way of the strategy also works as the scalping setups. If you learn something new, and hit the like button since it will help us out, and subscribe to stay updated with the latest released, and check out our academy program if you want to the future level up your trading. Until next time.